So the Bank of Canada held interest rates at 2.25%. That was absolutely zero surprise for anyone. The market odds, they were 94%. But here's what is actually kind of surprising and what could end up costing Canadians an extra $718 specifically per month when they renew their upcoming mortgages. If you bought your home in 2021 or you're thinking about entering the market, the next 15 minutes could be the difference between making a massively intelligent financial decision and a catastrophic one. And I'm not just making that up. There's a massive difference in how much money you can be spending. So here's what I'm going to be covering. Number one, why the Bank of Canada claims that everything is resilient while Canadians are returning finance vehicles literally to stay afloat right now. Number two, the hidden payment shock coming for hundreds of thousands of Canadian homeowners who bought between 2020 and 2022, more specifically some of the major markets. And number three, what this rate hold actually means for house prices and why they're still not responding the way that you'd expect yet. Now, I'm going to show you the real data. I fact-checked as much as I could before this video, knowing I produced this literally an hour after the Bank of Canada's decision. We looked through the Bank of Canada's claims, and I'm going to explain to you exactly how what they said impacts you. Now, of course, data can change as time goes on for the next video, but let's break down exactly what happened today. At 9:45 Eastern Time, the Bank of Canada held its overnight rate at 2.25%, exactly as it was expected. Governor Tiff Macklem stated that the policy rate was about the right level to keep inflation close to 2% while helping the economy through this period of structural, in this case, structural adjustment. But let's pump the brakes here for a second. This is their first hold since October after 9 consecutive rate cuts since the summer of 2024. Think about that. We had 9 cuts from 5% all the way down to 2.25%. It's significant, a drop of 2.75% points. Now, when central banks cut rates this aggressively, you would expect certain things to actually happen. You'd expect the economy to respond positively. You typically would expect housing to heat up, and you'd expect Canadians to start to feel relief. So here's my question for you. Are you feeling the relief? The key numbers to consider here, current rate is 2.25%. We've got 94% probability of this whole rate change and 2.75% cut from the peak. That's a lot of factors to consider. So here's what happened immediately after the announcement. Couple of key figures to look out for. The 2-year bond yield fell about 4 basis points, not massive, notable. And the 5-year yield, which shot up like a rocket right after the jobs report last week, and this directly impacts typically 5-year fixed rate mortgages, it dropped a little bit. The Canadian dollar also fell like a rock to 72.1 cents US. Now, markets took this as what they're calling a quote-unquote dovish hold. The translation to that is the Bank of Canada isn't rushing to raise rates anytime soon, so don't worry about that. But, and this is critical, money markets are pricing in about equal odds for a 25 basis point hike by the end of next summer. Now, again, remember, this is not a guarantee. This is based on today, and there's a lot of data that can come in between today and the summer. And just as easily as there could be a rate hike, we could see things tumble back down in January, February, and see a rate drop. But if you didn't catch that, that's a significant change from last time we were talking. Well, the bank says rates are about right. The markets are basically betting right now that rates can go up within 6 months. It's not exactly a vote of confidence in the market's current strategy or the Bank of Canada's current strategy. Now, this is where things actually kind of get interesting and where the Bank of Canada narrative starts to crack when you look at what's actually happening to Canadian households. So let's look at what the Bank of Canada is actually celebrating here. Number one, unemployment rate dropped to 6.5% in November. That's down 0.4 percentage points from October. That means we're gaining jobs. The economy showed an unexpected jump in GDP, which sounds amazing. The country is doing better. And headline inflation came in at 2.2%, down from 2.4%. Again, sounds like we're on the right track. I would say not so fast, though. Let's start with jobs. Yes, Canada added 53,600 jobs in November, but here's what they're not telling you here. According to the data, Canada lost 27,900 full-time jobs over the past 2 months while creating 150,000 part-time jobs. So picture this, you're a Canadian worker and you lose your full-time position with benefits, pension, contributions, and stability, and you pick up 2 part-time gigs. Statistically, that counts as 2 new jobs. The unemployment rate goes down and the Bank of Canada celebrates. That could be one of the reasons that so many Canadians are feeling broke. But in this case, you're working more hours for less security and probably less total income. Is that resilience or is that desperation? Let's talk about that GDP growth. Economists are warning that this number is masking serious weaknesses. It's because the GDP growth came largely from a statistical quirk. When imports fall and exports stay flat, it creates this mathematical impression of growth. That government investment went up 12.2%, which was funded by another $5 billion of government spending. So to get this straight, the government essentially borrows $5 billion in 1 month and increases our country's GDP, and household spending declined. To me, that's a bit of a red flag. And the kicker to all this is that the bank's monetary policy report, this is getting deep here, it predicts consumption growth will slow, which means less spending as unemployment constrains disposable spending. Basically, what they're saying is that people have less money to spend. Now, before I go on this rant anymore about what happened, we need to know that for you as a mortgage holder, this has serious and specific clear impacts on your current existing mortgage. If you have a variable rate mortgage or a line of credit, there's no change to your monthly payment. And no, I'm not telling everyone to go in and lock in your mortgage. If you follow the video, I'll get into what my recommendations are, not necessarily today. But I want to tell you that this is what essentially the BOC is looking at right now, and this is why they made this decision. Now, I want to know what really is interesting. There's a gentleman named Scott Terrier, a manager of consumer insolvency at Hoyes. It's a long name. Anyways, he said this is the first year in 17 years on the job that Canadians are contacting his firm with the intention of returning finance vehicles. This means that Canadians aren't just struggling, they're giving back their cars because they literally cannot afford them. That's financial triage. But it gets worse because there's a massive payment shock coming for a lot of homeowners, and almost nobody's really talking about it. What I'm talking about specifically is this potential renewal crisis. Now, again, I want to be hyper clear. I'm not suggesting that everybody's about to lose their homes, and I'm not suggesting that everybody's payments are going to go up dramatically. In fact, I've talked to a lot of families that are going to be just fine. But I do want to call out what reality is. Painting a picture for it's 2021 and you're a first-time home buyer. The housing market is on absolute fire. Interest rates are at historic lows. The Bank of Canada is at 0.25%. It makes a lot of sense. You've got Justin Trudeau saying, hey, rates are going to stay low for a long time, spend money. And so you stretch hard to get into the market when you see property values going up. Your average purchase price across different times in 2021, according to the information data that I looked at today, properties are going anywhere from $700,000 all the way up to $900,000 over the course of 1 year. You get a 1.5% fixed rate mortgage or maybe a 1% variable rate. Your monthly payment felt pretty good. Life is really good. Fast forward to today, December 2025, your mortgage is coming up for renewal and that 1.5 rate is gone forever. Now, a lot of people can handle the increase in payments, whether it's because they extend their amortization or not. But if we're running the actual numbers, to give you examples of 4 real life scenarios, we've got, let's say, someone who bought their property in 21 for $774,000. After 5 years of payments at 1.5%, they owe about $689,000. And they renew back with 20 years at a 4% rate. Their monthly payment increases by $844 per month. That's pretty significant. Now, though that person could choose to extend the amortization back to 30 years to reduce the payment, see an increase. It wouldn't be as significant on their lifestyle, but that is a big change. Someone else who bought in April 21 for $874, current balance of $779, their renewal increase is $927. Someone who bought in July of that year, which was the peak of the market, the current market, well, not the peak of the market, but it was getting closer and closer. July, their current balance $818, their renewal increase $953, and someone who bought in October, which was getting closer, $807 for the same property, current mortgage is $720, and their payment increases by $1,049, which means the average payment increase for a Canadian who bought during that year could be as much as $718 per month. Now, normally in this situation, most people would refinance, they would tap into the home equity. But one of the challenges associated with that is if the average property value in that circumstance with that window of properties is now $833,000, some of these people won't have the option because they won't have equity. Now, there are different types of opportunities that will be available, so it's not all lost. If you're one of those people that was up in 21, I would say that thankfully a lot of people have gained enough equity in that timeline such that they can refinance. There are lenders where you can switch over and go back to 25 years in some circumstances. So there are options, but it will likely have a negative impact on consumer spending. And this is why the headlines aren't everything. So stick with me while I explain this. Remember, private consumption, which is people buying things for personal reasons, is 54.5% of Canada's GDP. If hundreds of thousands of homeowners suddenly have up to $700 less money to spend, what do you think happens to the economy? And this is the part that really kind of shocked me the most, because despite 9 rate cuts and 2.75% off of the overnight rate, house prices did something that were kind of unexpected. I mean, if you look historically speaking, every major Bank of Canada rate cycle going back to 1989 and 96, the rates dropped from 5.73 to 3.25% in over 12 months. 2001, rates dropped from 5.75 to 2.5% over 12 months, and 2008 from 4.25 to 1.75 over 12 months. 2020, 1.75 to 0.25. You get the picture, right? Comparatively speaking, in every previous cycle, when rates drops, home prices responded sometimes immediately, sometimes with a lag, but they always moved higher. And in 2025, the bank started cutting rates from 24 to 25. And even during that time, Canadian home values have actually dropped up to 25% off the peak when rates came down, which doesn't make a lot of sense. Basically, you've got higher rates, lower prices back in 2023. But the most interesting part is dropping from 5 to 2.25%. Home prices actually dropped by 1.4% during that time. Now, that's not a big drop. In 2023, people were asking me if it was the right time to buy. And theoretically, it looked like it would have been the peak with rates being at the top and the market coming down. There were some thoughts that it would have made sense to purchase a piece of real estate during that time before rates started coming down when property values were deflated. But right now, economics 101 is not even mattering at all. And I think there's a couple different factors at play. Number one, we have what we call the affordability ceiling. Even with lower rates, homes are very expensive relative to incomes, such that buyers simply can't qualify for the mortgage that they need. And the stress test still assumes that you have to pay a higher rate. The second is consumer confidence is out the window. When you're returning finance vehicles to make ends meet, you're not thinking about upgrading your home. And if you're that person and you're losing full-time work, obviously you're not shopping for real estate. And the third is the trade war effect. Canada's housing market has shown little reaction to rate cuts over the last year and a half, with experts saying the BOC's influence has been a poor match to the trade war. Business investment is lower right now and uncertainty is high. Because of this ongoing trade war, people are just waiting. They're sitting on the sidelines. So what does this mean for you? If you're buying, selling, or refinancing the next 12 months, this is probably what you should know from this information. I'm going to break it down into 3 groups. First of all, if you're a buyer, the rate cut of 2.25% means, of course, the variable rates are not changing this month. Your pre-approval is the same. Markets are pricing in potential rate hikes by the summer of 2026, but based on this data, we could see that change happen next year. If you're on the fence, I think you should understand that rates may not go lower from here. This could be as good as it gets for the next 12 to 18 months. However, this is critical. Don't let the fear of rising rates push you to purchase something that you can't afford or something that you don't want. Run your numbers at 4%, not 2.25%. Just basically run your numbers at a 1% or 1.5% higher than reality. Because if you renew in 5 years, you want the numbers to be able to work out for you. I mean, if you're buying a home and you're buying a home for 5 to 7 years, then it doesn't really matter if you're buying it today or tomorrow, but this is something to be conscious of. If you're a seller, your market has not responded to rate cuts. And if you're waiting for some kind of surge because rates are going to be lower in the spring, I'd manage those expectations. The data is showing that the prices in most areas of the country, BC and Ontario specifically, are probably not going down. And even with 9 rate cuts not responding, affordability and consumer confidence are still low. I wouldn't expect your house price to continue to go up. If you have to sell today, price it competitively. This is not a market for testing your home price. We've seen it over and over again. For everybody else renewing your mortgage in 26, this is where you need to pay attention. If you bought in 20, 21, or 22, get ahead of your renewal and talk to your advisor today. Don't just talk to your bank. Talk to your advisor. Get clarity. If you have equity and you need to explore refinancing, do it early. Lock in early if you can, or at least get a rate hold. If you don't have equity and you need to plan for a potential payment increase, at least you need to know what this payment would be, such that when it hits you, it's not a shock or a surprise. Don't wait until 30 years before renewal because it'll end up costing you money. And the bottom line is that the Bank of Canada is saying that the economy is proving resilient. And the data is telling us a completely different story when Canadians are returning vehicles and full-time jobs are being turned into part-time jobs. And while the Bank of Canada is celebrating, it's hitting its targets and all these numbers, the market is expecting rates to potentially jump up, there's a lot of reasons to suggest this could all be a mirage. And in 3 to 6 months, we come back to this rate cutting cycle. Obviously, the question is the data consistent or not? So here's what I'm watching for, what's coming up next, what I'm paying attention to. December 15th, November's inflation drops. If that goes back up, the case for rate hikes strengthen. In December 19th, retail sales data comes out. We'll find out if consumers are spending more money or pulling back around the Christmas time. In December 23rd, Q4's GDP is reading. If that's weak, then we might have a fragile economy. And then in January of 2026, this is the big one. What are those jobs looking like? Are people losing or getting full-time jobs? That is the big question. Now, if you want to stay ahead of this information and you want clarity for what's going to happen with the next Bank of Canada meeting for January 28th, between now and then, we have a lot of information and data that's coming up. Make sure to subscribe to the podcast or the YouTube, hit like, and hit that notification bell if you found this information valuable. My goal for going forward into 2026 will be to create more advisory-based content and giving you frameworks to deal with this and not just telling you what's going on. Again, if you found this information helpful, give me a comment, give me a thumbs up, give me a subscribe. And if you want to find out more information on the day-to-day basis, follow me on Instagram at The Mortgage Pug, where I post every single day valuable data and snippets that you can use to improve your financial wellness. See you on the next one.